Hello everyone, and welcome back to our channel Time. Today's video is all about a shocking update that could transform the gold and silver markets forever. Buckle up, because China's latest move might just blow your mind.
What we're seeing now is the gold stocks outperforming, but barely outperforming. I'm just looking at this year. Gold is up 21.5%, and the GDX is up 26%. So they're barely outperforming. That is an unusual circumstance. And frankly, it's a circumstance as a reflection of who's buying and why they've been buying. As I just said, you don't expect the Chinese central bank, People's Bank of China, to be buying Agnico and Newmont and Barrick. You expect them to buy physical gold. As that shifts, and we're seeing the shift now, as that shifts and money moves into gold stocks, I think the moves are going to be very, very strong, and they're going to play catch-up.
Recent developments in the global gold market indicate a significant shift, with China potentially set for a notable comeback after months of reduced activity. Adrian, a renowned financial expert specializing in gold-related investments, provides insights into these changing trends. Day observes that while gold prices have been performing well, gold stocks have lagged behind. This disparity has primarily been due to central banks and Chinese retail investors focusing on physical bullion rather than stocks, while Western investors have been net sellers. However, the landscape has been evolving over the past few months. The Chinese National Bank, previously the most significant gold buyer, has not made any purchases for 3 months, and Chinese retail demand has softened. Despite this lull, Chinese authorities have recently increased import quotas for banks, hinting at a potential uptick in demand. This shift comes at a crucial time, with gold prices hovering near all-time highs, supported by signals from the U.S. Federal Reserve suggesting a potential interest rate cut at their September policy meeting. The appeal of precious metals as a hedge against economic uncertainty remains strong. Interestingly, Chinese gold imports have seen a significant decline in recent months, with July imports falling 24% to 44.6 tons, the lowest in over 2 years, following an even sharper 58% decline in June. However, these figures may soon reverse course. According to an exclusive report by Reuters, China, the world's largest gold consumer, appears to be gearing up for a significant return to the gold market. This potential resurgence could have far-reaching effects on global gold prices as Chinese demand ramps up once again. Be sure to explore Adrian Day's expert analysis further. Make sure to subscribe to our channel and hit the bell icon to stay updated with our latest content. Thanks for watching, and enjoy the video.
Recently, we really had gold performing well, but the gold stocks in general not. And we know the reasons for that. The reasons for that was because the drivers of the gold price were central banks and Chinese consumers, Chinese retail investors, who are generally going to buy bullion and not going to buy gold stocks. Gold was driven by these factors, and Western investors, both in the US, in North America, and in Europe, were actually net sellers of gold. And so it was perfectly logical that gold was going up and the gold stocks were not. That has shifted or changed quite fundamentally in the last few months. I mean, first of all, we've had the Chinese National Bank, which was the largest buyer of gold, has not bought for 3 months. Chinese retail has been kind of soft for the last month or two. And in fact, good news overnight, good news from China, the Chinese authorities allowed the banks to increase the import quotas for gold for the various banks. That's how gold gets into China. If it doesn't come from the Shanghai Exchange, it comes through Hong Kong, imported by the banks, and then is distributed. You don't increase quotas unless demand is picking up, I don't think. At the same time we've seen that, we've started to see net inflows into the ETFs in the West, both in Europe and in North America. Because if you remember, up until, let's say, the end of May, we were still seeing steady and consistent outflows of physical gold from the ETFs. In the last month, we've seen, let me just look at my number here. Yeah, so in the last 2 years, the assets in the ETF has gone from 105 billion to 85 million, that's a huge decline given that the price of gold has gone up. You'd expect the value of the assets to have gone up. So we were getting these ongoing outflows. That has changed just really in the last couple of months. We're beginning to see inflows as well as outflows. Now, I don't want to exaggerate that, because even over the last month, we had more outflows than inflows.
Yes.
There's been a shift. We're beginning to see inflows into the GDX. We're still seeing outflows from gold stock vehicles, both mutual funds and ETFs. So if you look at your GDX, for example, even over the last month, with gold at record highs, we had more outflows than inflows. They don't report their inflows and outflows every day. I think they only report inflows, outflows if they're significant. Otherwise, they just stay in cash. They don't get invested. So in the last month, we've only had 3 days. We've only had 3 days where VanEck has reported net inflows into the GDX. That's pretty astonishing. When that turns, so I think what we have right now is, frankly, David, I think we have this very, very remarkable opportunity, because typically at the beginning of a bull market, when gold turns, typically within a month, 3 months, 6 months, the gold stocks well outperform gold, which is what you would expect. They have leverage, right?
Recent performance in the gold sector indicates a promising opportunity for investors, especially in gold mining stocks. While the VanEck Gold Miners ETF has only shown modest gains, industry experts believe this may be a precursor to a larger move in the second quarter of 2024. The GDX ETF posted a 7.3% increase, leveraging a 4.7% rise in gold prices, which is a factor of 1.6. Although this is below the typical 2x to 3x amplification that major gold miners usually provide relative to gold price movements, it suggests a positive trend that could accelerate as the gold bull market matures. Adrian Day is particularly optimistic, noting that the bull market in gold stocks is just beginning. Despite a 30% rise year-to-date, historical patterns show that gold stocks can see gains of 400% to 500% during bull markets, indicating significant upside potential still remains. Let's get back to the interview.
I think typically when you have a sharp drop in the market, and that's a reflection of the drop in the broad stock market. When you have a sharp drop in the market, you expect those stocks to drop.
Yeah.
We saw that, as you say, in 2001, 2020. We saw that in 2008. But, and this is very important, they tend to come back much quicker than the broad market. And you just pointed out there in 2000, the gold stocks had recovered within a couple of months. It looks like on your graph, they tend to come back much, much sooner than other stocks. And so in 2008, for example, gold bottomed in August, gold stocks bottomed in October. Gold stocks were already up 50% by March. So what's that? That's 5 months. They were already up 50% by March, which is when the S&P bottomed.
Yes.
So the gold stocks tend to drop sharply, but come back much, much sooner. And if you look at inflation, if you look at recessions generally, I mean, we're talking about a little bit we're talking about both apples and oranges here, because we're talking about drops in the stock market and recessions. But if you look at recessions, gold stocks actually tend to do relatively well during a recessionary period. History would show us that. I think so, definitely. But it's not so much retail people and small investors moving into ETFs. It's more people in the West, but large families, institutions, large investors who are moving into gold and moving into gold stocks. You can see that these are all OTC trades, so each trade is not reported. But of course, you see the numbers at the end of the month. You see the aggregate numbers at the end of the month, and that would suggest that there is some very, very large buying of physical gold over the counter, and it's certainly not coming from ETFs. So one surmises, and the World Gold Council surmises but this is coming from large individuals who are buying. If the buying's in London, the buying's not in Shanghai, that's another indication of this Western buying. I think the bull market in gold stocks is just at the, I won't use a baseball analogy because I'll probably mess it up, but it's just at the beginning. I mean, you look back at other gold bull markets, whether it's 1971, 1976, 2000, 2008, the gold stocks typically will go up 400-500%. Nowhere near that at the moment. Nowhere near that. And the gold stocks today, even though we've had good moves this year, most of them are still, in terms of price, they're still significantly lower than where they were in 2010-11, but most of them are even lower than where they were in 2020. Yeah, in terms of price, we've got a long way to go. And in terms of valuation, they are still very, very, very cheap.
The next few months will be crucial in determining if gold stocks can close the performance gap and deliver the substantial returns that many market experts are anticipating. As this situation develops, consider what factors will be most important in driving gold stock performance and how investors can best position themselves to take advantage of potential opportunities in this sector. Share your thoughts in the comments below, and if you found this video helpful, please join our community by subscribing to our channel and turning on notifications with the bell icon. Thank you for being a part of our community.